Cryptocurrency Margin or Leverage Trading Tutorial Part 1. In this tutorial, I'm going to cover everything you need to start using margin or leverage trading, which I have the controversial opinion that everyone who trades Bitcoin should be using. I'll explain why later in this video. So the content we're going to cover. We're going to talk about how to select the right cryptocurrency exchange. We're going to talk about the prerequisites required for someone before they start using margin or leverage trading. We're going to make sure we understand the products we're trading on these exchanges. And then we're going to talk about the correct ways of using margin and leverage. So I'm going to go over the usual disclaimers. This video is for entertainment purposes only. Any information spoken or written should not be interpreted as financial advice. Carry out your own independent verification of facts and data. Don't just take my word for anything. I am not a financial advisor. I do not hold any relevant qualifications. If you seek financial advice, speak to a professional. And finally, trading is an extremely risky activity. Your trades are your responsibility, so trade at your own risk. Selecting the right cryptocurrency exchange. So let's talk about what I look for when selecting an exchange and why I've chosen the exchange of my choice. First off, make sure it offers margin trading. Whatever exchange you're looking at, make sure it offers this, and most do, so this shouldn't be much of an issue for everyone. Make sure your exchange offers the best technology. Crypto's been around for a while now, and initially there wasn't that much money or experience in the industry, especially when it comes to exchanges. A lot of the older exchanges have outdated technology that often gets overloaded and overrun when there's a lot of volume and volatility in the market. So for this primary reason, I like to avoid exchanges like BitMEX, because the last thing I want when trying to execute a trade during a very important time is to get an error message or for even the website to go down. I choose FEMEX as my exchange of choice. Why? Because it's the fastest exchange there is, and the team behind this consists of ex-Morgan Stanley execs. These guys know what they're doing, and they've built an exchange with an incredible matching system. They can execute 300,000 transactions per second, so you are minimizing your chances of getting error messages or having lag when you're putting your orders out, any sort of technical error, and that's extremely important for me if I want to be comfortable when trading. Next, you want to make sure there's enough liquidity. Now, this is where an exchange like BitMEX is going to shine because it's obviously got the most money being traded there and therefore the most liquidity. But there's a limit to how much liquidity you need unless you're trading extremely large position sizes. So if you're someone like me who's trading normally 5 to 6 figure positions or any amount less than that, then an exchange like FEMEX is going to be perfectly fine. If I was trading $1 million, $10 million positions, then yeah, I'd be more likely to be trading on BitMEX, but because I'm not, I really don't need to be trading that. For me, it's very important to also have more than just crypto. Diversification is your friend when it comes to trading. You don't want to be entirely reliant on one market and have all your returns be correlated to that. As you become a better trader, you want to expand to other markets and learn to trade other assets. FEMEX, I know they offer gold right now, and they have plans of introducing a lot more traditional assets. So I've chosen them because I want to do all my trading in one place. And once I become comfortable with a platform, I don't really want to get used to the UI of a different platform. Another really important thing for me is no KYC. Now, I have my reasons for this, and I know a lot of other people, especially those who are in crypto, are very concerned about their data and their privacy. So this is very appealing, and FEMEX offers this, so yet another reason why I choose to trade with them as opposed to any other exchange. Finally, advanced order types and trading tools are very important to me. I normally get a developer to develop tools I need for me, or I use third-party software. Now, I like to avoid this if my exchange offers these tools themselves. So a lot of my systems use trailing stop losses. Now, most exchanges don't offer tools like trailing stop losses, even though they're so simple to implement. Another reason why FEMEX stands out from the crowd for me and why I choose them. Now, you guys can choose any exchange you want, but these are the key things I like to look for in my exchange, and you can make sure your exchange has these as well. If, like me, you want to try out FEMEX, I've got a link in the description below you can use to see if they meet your needs. Now let's talk about the prerequisites before you start margin or leverage trading. Firstly, make sure you understand technical analysis. Don't go into this blind. Make sure you know how to develop a trading system. Make sure you understand proper risk management. You need to know how to place stop loss, how to place take profit orders, how to size your positions. All of this stuff should be second nature for you before you even step onto the exchange. And finally, trade psychology, just as important as any other factor and often overlooked. You need to have the mental discipline and emotional control to not do stupid things at the exchange, because you have the ability to liquidate your assets and lose all of your money. This is a possibility, and one slip up can wipe out years of trading profits. So extremely important. You also want to understand the exchange you are using and the product you are trading. Under what conditions will your position be liquidated? Are there funding fees attached to the product you're trading? Is there an expiry date to the contract you're trading? You need to know all of this before you step onto the exchange. So following on from that, let's start by making sure we understand the product we're trading. And the product I'm going to explain is what we trade on Femex, which is a derivative and not the actual asset itself. Let's take a look at this on the actual exchange and explain a bit more about it. Here I'm using a testnet account to show you guys the exchange and all the different features it has. So if you take a look around, you'll see it's got all the standard things you'd expect on any regular exchange. There are some things which are a little more complicated than others, and I'm going to go into detail explaining those. Contract details is one of those. When I say understand the product you're trading, you need to understand what all of these things here mean. Femex doesn't actually let you trade Bitcoin, the asset itself. What it does is provide you guys with a derivative product where it matches as closely as it can the price of the asset. And to match it, what it does is it provides incentives through funding. So funding can be negative or positive. When funding is positive, we know that longs have to pay shorts to open positions. When funding is negative, it's the other way around. And it provides you with a predicted rate as well, which is exactly what it sounds like. So next we have these three prices over here. So the last price gives you the last price that was traded on the exchange. Then you have the index price. Now, how the index price works is the exchange takes a lot of the biggest, most popular exchanges like, say, Coinbase or Bitstamp, and it takes all the prices of these different exchanges, averages them out using their own formulas, and comes up with an index price to match the asset as closely as it can. Next, we have the mark price. Now, the mark price is your liquidation price. Now, often this is going to vary from the exact index price, and you need to pay close attention to this, especially during times of extreme volatility. There's going to be a difference between the mark and index price. You can see right now it's about $7, but as volatility increases, so can this gap. So when you open positions, you need to always make sure you're looking at the mark price, not the index price. If you're using high leverage and not paying attention, this could result in instant liquidation of a position. We have these derivatives where we have to pay a funding rate to use them. Then we have the different prices attached to these. And finally, you can see here we have 24-hour turnover, volume, and open interest. Now, volume, open interest, turnover, this is just how much trading activity is going on. And if you're interested in learning more about that, I actually have a lesson on my technical analysis course, which covers those in great detail. But for the purposes of this video, all we're trying to do is understand the product we're trading. So if we look around the exchange, we can see it's very easy to navigate and move things around. So if you have certain preferences with regards to customization, it's very easy to move things around and get it exactly how you want it. If you plan on having a career in trading, you're going to be using this for a very long time, and you want to be able to have it exactly how you want it. Okay, so now we understand that we are trading a derivative and not the actual product itself. We know we have to either pay or receive a funding fee depending on whether funding is negative or positive and whether we're long or short. Let's move on to the next part. What is margin and leverage? So margin is collateral. It's the capital you pledge as security to make your trades, and leverage is your buying power multiple. We can make this a little clearer by looking at the exchange itself. So your margin balance is your collateral. This is the money you put up onto the exchange that's at risk. the exchange uses this to give you your buying power multiple, which is leverage, which you can see over here. So I can lose up to $2, which is what I have on this testnet account, depending on what leverage I'm using. So if I open a $10 position using 10x leverage at market, confirm, you can see that I now have $1 at risk, because 1 times 10 equals 10. That means to open this $10 position, you can see that my margin, or the amount of capital I put at risk, is $1, and I've used 10x leverage. Now what I can do is swap 10x to cross. So cross isn't flat, it's an auto leverage. So it automatically calculates how much leverage I need to use to keep this position open. So it automatically sets it at 5.14x, and it adjusts it depending on what the position is doing. So the advantages of this are I don't need to think, and I can open any position based on my collateral over here. But the disadvantage is, if I'm not using a stop loss, I could liquidate my entire account. Hopefully you understand what margin and leverage are. I will explain all the different order types and specifics of opening and managing a position in the next video. So like I've said in part 2, I'm going to explain how you can use these on the actual exchange. Before that, I want to make sure you guys know how to use leverage properly. Leverage can be your friend. It can be a useful tool, and it can help mitigate risk rather than add risk, but you have to know how to use it. So there are only 2 ways I use leverage. The first is to mitigate counterparty risk, and the second is to adjust position size and make it larger than my total portfolio might be, as long as it still adheres to my risk management rules. Mitigating counterparty risk. Instead of putting $100,000 worth of Bitcoin onto an exchange to trade a $100,000 portfolio, what you can do instead is only put up $10,000 worth of your Bitcoin and then use 10x leverage to trade it as if it were a 100k portfolio. This is no different to trading a 100k portfolio, but only $10,000 of your Bitcoin is on the exchange and at risk. So this is very different to how people normally use leverage, and that is they'll take their $100,000 worth of Bitcoin and use 10x leverage to trade it as if it were $1 million. So there's a big difference between the two. One of them is putting less of your money at risk, and the other is increasing the risk you have on your current portfolio. Hopefully the difference is clear. So the other way you can use leverage, or at least I use leverage, is to adjust position size while still adhering to your risk management rules. So this applies when you have a tight stop loss, usually less than 1%, unless your account risk is higher, then it can be less than, say, 3%, 5%, however much risk you're taking per trade. This will be a lot clearer in an example. There are 3 pieces of information we need. What is our max risk per trade? My max risk per trade in this example is going to be the $100,000 portfolio, and I'm risking 1%. So 1% of this is $1,000 per trade. So I'm allowed to lose up to $1,000 per trade I take. Now, in this trade setup I found, what is my current risk, or rather my stop loss distance? So let's assume the stop loss distance is 0.5% from where I'm entering my trade. So if I use my entire portfolio, $100,000, and use the 0.5% stop loss, I'm only putting $500 at risk per trade. So what I can do instead is use 2x leverage to change this $100,000 portfolio into a $200,000 portfolio. So now I'm taking a $200,000 position with a stop loss at 0.5, and I'm still adhering to my rules, because we can use leverage to create a $200,000 position, and we're only losing up to $1,000 per trade because our stop loss is 0.5% away. And the formula to calculate this is just dividing your max risk by your stop loss distance. So $1,000 divided by 0.5% is the same as $1,000 divided by 0.005%, which is $200,000. So it can be used as a position. So as you can see, leverage can be used as a position sizing tool to increase your max position size, but you still adhere to your risk management rules. So these are the 2 ways I personally use leverage, and the 2 ways I think are the correct way to use leverage. Now, in part 2 of this tutorial, which I will release next week, I'm going to go over the different order types, how to navigate and use the exchange itself. Until then, I hope you enjoyed this video.